What's a tax hack that feels illegal to know, whether you vouch for doing it or not even? Like, what's something that really, every time you hear it, you're like, I can't even believe that's a thing.
So there's something called
What's up, guys? Welcome to the Social Media Entrepreneurs Podcast, teaching you how to become a full-time entrepreneur by leveraging modern social media strategies. I'm your host, Derek Vidal, and today I'm joined by Matt Sercely. He's the founder of Agorist Tax Advice, and this is a topic that we've only talked about one other time on this show's 380 episode span here. So this is a topic I'm really excited to get into. We were just talking beforehand about some of his major tips that he gives out, and you guys are going to be able to apply this information to save a ton on taxes. So we are about to come up on tax season. It will be here before we know it, that you're having to pay those taxes from the year before. And this is really where a lot of entrepreneurs make it or break it. It's really where a lot of high income earners of all types make it or break it, because I actually just saw on Facebook yesterday this article. It was like 20 celebrities that lost it all. And every single one of them was because they didn't pay their taxes. They just spent all their money and they didn't properly pay their taxes. And now they're just owing the IRS. Like Ron Weasley was one of them. Rupert Grint, he owes the IRS like over $1 million. And they're all having to live a lot more humbly because of it. So how can you save as much as you can legally is what we're talking about today. We got a lot of quick implementable tips. So get ready to take some notes. Matthew, how's it going today?
It's going absolutely great. Really excited to be here.
Great to have you, man. So to start off here, let's talk about just the foundation of your company and like how you came to be and why you came to be. Like, what is the main problem that you saw that entrepreneurs were just really leaving all this money on the table that you decided to start this company in 2020?
So, 2020 was COVID. It was a bad year for a lot of people. My day job was not looking like it might continue on, so I was looking for something on the side. And I'd always kind of been the tax guy in my firm. So I said, well, let me kind of do my own thing. And what I do is I help people set up their company and take actions today so that when they file their taxes next year or the following year or the following year, they owe a lot less money. And so it's commonly called tax avoidance. You're avoiding the taxes by taking legal actions. And there's lots of things companies can do that if you just set up your company right, you owe less money. If you set up your company wrong, you may owe a lot more money.
And I really like how you were phrasing it earlier, that a lot of times it's things that people are already spending money on that are personal expenses. However, if they change some things around or maybe did some things differently, that all of a sudden could be a business expense. So give me a couple of those fun ones. And by the way, guys, at the end of this episode, we'll have a free guide for you that he put together on just a ton of these different things that you could be saving money on or writing off as business expenses. But what would be some of the most popular ones?
Well, before I go into that, I do just want to warn anybody, just because something is deductible for one person doesn't mean it's deductible for you. If this doesn't sound right or if this doesn't feel right, make sure to consult somebody before you do it, because there are different rules that apply to different businesses. But just starting off, one of my favorite things is like you better be writing off your cell phone and your cell phone bill. I mean, if you have a business, I guarantee you're using your phone for your business. So at least part of that bill should be deductible. Now, the IRS says you're supposed to keep track of your minutes on your phone and deduct on that percentage. But there's a bit of a side rule here that says if it's a secondary phone for your business, if you have a primary phone for personal use, you can expense the whole cell phone. Well, all you need is a relatively cheap voice over IP phone and a free Google Voice phone number. And now you have a primary phone at your house. And again, assuming you follow the other rules, you should be able to expense the full cost of your cell phone and your cell phone bill for your business.
That primary phone, you said using a Google Voice number, and then do you have to buy a physical phone to act as a landline tied to that?
You probably do. If it runs to your cell phone, then you certainly can't deduct the full price of your cell phone as a business expense under this exception. But I mean, there are voice over IP phones for, $50. So, very quickly you come out ahead by doing this.
So to clarify, are you buying a physical phone in that situation, or you're just buying that $50 service that
It's
you're talking about?
no, it's a physical voice over IP phone, a physical
Okay,
phone. And but again, you don't have to pay for a voice over IP ongoing monthly service.
gotcha.
Google Voice will give you a free phone number, and you can just use that.
Okay, awesome. Yeah, that's a great one. I think a lot of people are writing off their phone, and when it comes down to knowing what percentage they should do, it's always difficult, but it's so much easier if it's just 100%, just because you could now designate it as your pure business phone. What would be another tip like this?
So in general, one of my favorite things to do is look at if you're giving money to somebody else already, often a child, but sometimes, a family friend or a relative. If you can hire them as an employee instead, now everything you pay them is going to be tax deductible for you. Now, maybe they owe tax on it now, but especially with your kids, they have their own standard deduction. So right now in 2023, you can pay them nearly $13,000 and they owe $0 in income tax on that, but you get to write that off. So if you're like most people in the 24% tax bracket, you pay them, say, $5,000, you just save $1,250 almost in taxes. But then you use that money to buy stuff you would have spent on anyway. So if your kid's in scouts, now they pay for their scouting activities. If they take music lessons, now they pay for their music lessons. They pay for the rental of their whatever. Anything you're paying for your kids anyway, as long as it's not a necessity, you can pay them and then have your kid pay for it.
So you're paying the kid through Venmo or something of the sort, and that transaction is listed as a payment for their wage, and then the kid is sending the money to Girl Scouts or whatever it is they're doing.
Well, if they're a minor, you can be in control of the bank account and you can be the one actually sending the money from their bank account.
Okay.
Now, that said, it needs to be a legitimate employee relationship. They need to actually be working for your company, and it's got to be a reasonable wage. You can't hire your 10-year-old for 5 hours and pay them $5,000. You also do need to follow state law on this. So in some states like California, this is a little harder to do. But I mean, if you have a web page or if you have social media and you just, take pictures of yourself and your family, you can pay your kid a modeling fee. So even your 1 or 2-year-old, they can earn $500 or $1,000 a year in income. That again, if it's some stuff you would have spent on them anyway, but now it's tax deductible, you just come out ahead. The really cool thing is I have another friend who's a CPA that he recommends this, and one of his clients hired his 10-year-old as his bookkeeper. Well, by the time the kid was 16 years old, he had a real bookkeeping business making 40 grand a year. So this doesn't have to just be a tax dodge. If you actually teach them a useful skill, they can turn it into their own business. And again, can you imagine being a 16-year-old and making 40 grand a year from a business you're running? Like, how far ahead would that put you in life?
That's genius. I love that example too of him then turning it into a career with that skill. And I think a lot of people listening have their kids in their content at some point. So that already is probably the easiest deduction that a lot of people can already take advantage of right there, that legitimately is their child doing some work for them. And you said in California, the laws are a little bit more strict with this. What's the general age that most of the nation will allow this? I mean, you said a 1 or 2-year-old that you could pay even. So is there not a
Yeah,
minimum age?
it's different in every single state. Many states have exceptions when you're employing your own kids. But again, I can't tell you what the rules are for every single state. But last I checked, it's about 37. That as long as only their parents own the company and the kid is, their legal child, including by adoption, if that's the case, usually there's no restrictions for them working for their parent.
Interesting. So they would look up child labor laws and then put in their state to find this information?
Yeah, pretty simple Google search, and usually there's a lot to find. And again, you know, some of this also comes to what are the penalties for violating these rules in most states? Maybe it's $100 fine. Do you really care? Probably not. It's a $5,000 fine. You probably better get it right.
All right, so I love both of these. We got the phone tip. I almost said trick. It feels like a trick, but it's not. I love how it's like totally legal the way that you're doing it. There's just like you have to set up things differently. It's not just a matter of, hey, just write off your full cell phone bill and tell them you got another one, or just send your kid $5,000 and have them sweep the garage. It's like, this is the legal way to go about it. Even if you were to get audited, then you would still check out completely on these write-offs. What's another one or two that you would like to mention?
So probably the most popular one is if you can travel and make it a business expense. So there's a lot of different ways to do this. Aside from this, I own some real estate, and I own real estate at 3 rental properties in the city where my in-laws live. And so you better believe every time we travel to the in-laws for Christmas or Thanksgiving or whatever, I make sure to go visit my properties. I visit my property manager, etc. So all the mileage there and back, we get to deduct that as a travel expense. The hotel that we stay in, we get to deduct as a business expense. The meals that my wife and I eat, we get to deduct as business expense. We pay separately for the kids because they're not in the business. But now, that whole trip, becomes a tax write-off. Now, if the IRS comes knocking, you better be able to show you actually did work when you were traveling like that. But it's pretty easy to do. Other ways to do it are find a place you want to go. You want to go to Las Vegas, you want to go to New York, you want to go to LA, you want to go to Miami. Find a conference that's there. Sign up for the conference, go to the conference. And now that's probably a business expense for your business. But the IRS, all they care about is, did you spend a majority of the day working? Well, they think the workday is 8 hours. So if you work 4.5 hours in a day, that's enough. So find some conference that does, maybe a 9 to 2 session. You've got the rest of the day to do whatever the heck you want. But now again, this trip you wanted to take anyway becomes tax deductible. And it doesn't have to be some conference tied directly to your business. Like, I don't have to find a CPA or attorney conference to go to. A marketing conference is good for my business. There's marketing conferences all over the place. There's business and accounting and mastermind groups all over the place. And so doing this is a great way. Again, if you want to go someplace anyway, this is a way to go. And the government may pay for anywhere from 20 to 40% of it for you.
How would you do this? Let's say, well, I took a trip already last year. It's my buddy. He's a realtor. I help him out with his marketing sometimes. I mean, it was a trip to Europe, right? So we didn't plan ahead here to be like, we should attend a conference real quick. We traveled Europe, and then you get back and you're like, wait, we probably should have set something up here where we owned an LLC together, or went to a conference or something like that. Is there another way that you could think that is a write-off?
So I'm first of all going to say international travel has additional rules if it's longer than a week.
Okay.
So anything 7 days or less, the normal rules apply. It's pretty easy to justify. After that, the IRS is going to look at the percentage of work days to not work days. The bigger issue also is in the standard rules. Weekends don't count against you. So if I want to, go to a conference that's on Thursday, Friday, then stay Saturday, Sunday, then come home Monday, that Saturday and Sunday aren't held against me if I don't work those days. But in international travel, they kind of are. But absolutely, if you were, even if the whole trip isn't deductible, let's say you're gone for 10 days. Let's say 5 of those days you set up meetups to meet listeners, that you go talk to, clients. Maybe you give a talk someplace. Now maybe you get to write off 50% of your airline fees and your hotel and your meals for those 5 days. That's still better than zero.
I was definitely still taking sales calls while I was out there, and we had plenty of time set aside for working. It wasn't done as meticulously as it could have been. And I think, doing some kind of conference would have been a great way to do it. Or documenting a little bit more of, like, we had a lot of conversations over dinner, but it's like, we're at a nice dinner in Milan, Italy. So it probably doesn't look like a clear cut, business expense to the IRS if they look into it.
Yeah. And also, just because you're working doesn't make it good enough. Like, when you're traveling, they want to see that the work you're doing is because of the travel.
Yeah.
Like, you can't just be a writer.
Gotcha.
And, I want to write in Scotland for the next 2 weeks, so I'm going to work there. You need to show a reason why you're traveling there. Now, if the reason is you're doing 3 book signings and then well, I don't really have anything else to do, but I am still writing here these other days. That can be good enough.
Gotcha.
But
You
they
can't
want a
just say for
reason why you.
inspiration.
No, specifically, there's a case saying that you can't do that.
Okay, gotcha.
Although there was a travel
I went to
writer
find
who
myself.
managed.
Can I say
There's
that?
a no, probably not. But there's a travel writer who managed to basically travel around the world for a couple of years and write off every bit of it because it was all for like legitimately he had a business doing travel writing, actually published books and such. That was totally legitimate. Um, Now you kind of went into something that's really important if you're going to work with either me or somebody else like me. Always talk to your tax professional before you do the thing. Like the thing I hate so much is like I literally had somebody reach out about 2 weeks ago. Hey, I just sold a rental property. How can I avoid the tax? Call me 30 days ago. Because there was something I could have done 30 days ago, a lot more I could have done 60 days ago. But today, there's not a whole lot anybody can do to help you. So, like, a lot of this is, some of this we can do retroactively, but there's a lot more options if you plan ahead.
That makes a lot of sense. And they probably weren't even that surprised by your answer, right? They're like, oh, dang, I can see how I should have contacted you first.
I mean, I think they were disappointed, but I mean, I've been interviewed multiple times. That is one of my common messages is like, if you're working with a tax professional or you have a major thing coming up, part of what working with someone like me is you save money, but part of it's just like you don't screw something up. So it's almost kind of like buying insurance some of the time too.
What's a tax hack that feels illegal to know, whether you vouch for doing it or not even? Like, what's something that really, every time you hear it, you're like, I can't even believe that's a thing.
Um, so there's something called a health reimbursement. It's either an account or something else. It's always abbreviated HRA. And it can be complicated to set up. Like most people can't just do this in a business if they don't do it intentionally. But you can essentially set it up so that every single dollar you pay in your medical expenses personally becomes a business expense for your company and becomes deductible. And medical expenses is incredibly broad in this context. Like this doesn't just cover going to the doctor, this covers buying over-the-counter medication. It can apply to if your kid is deaf or autistic or needs to go to some special school. That's medical treatment for a disability. And so that can become fully deductible. And so I have seen people write off 30 or 40 or $50,000 in personal expenses just by setting this up and doing it the right way. Now, this takes paperwork, it takes planning. It's not worth doing this if you're a healthy 25-year-old who needs, $1,000 of medical care a year. But it's really, really easy. I mean, again, if you're, I'm 40, my wife's 40. We got a lot more medical bills than we did 5 years ago, especially since we got 3 kids. So I'm in the process of setting one of these up for myself, actually, since frankly, I'm now making enough money in my company that I can afford to do this.
So do you have one of your kids holding the camera right now? One's holding a microphone so that they're all technically employed?
No. So I've got 3 kids. One is 11. She does my bookkeeping. So every Saturday she sits down for anywhere from 10 minutes to an hour and goes through all of my expenses and income for the week. I've got a 7-year-old. He's my janitor. So he cleans up my home office every Saturday, spends about an hour to do it. I pay him $20 a week for that. And then my 5-year-old, the only thing I do with her right now is she is in a couple of photographs here and there that I paid a modeling fee for.
Cool.
But definitely, like I practice what I preach, and my kids, Boy Scout fees, they pay themselves. Their music fees, they pay themselves. They also, I buy them video games, except I don't buy them video games. Now they buy themselves video games. And what I really love about this is not only am I saving on taxes by doing this, but it's actually teaching my kids responsibility. Because suddenly I can look and say, hey, your bank account has X dollars in it. Yes, you can go buy that video game with this, but then you'll have no money left for anything else. Are you really sure you want to go spend that money on that video game? And it's been interesting. Both my older kids, the first time it's like, oh yeah, I want it. And the second time it's like, oh, it really sucked to not have that money for something else. Maybe I won't spend it. And so there's an extra advantage of just teaching your kids to be responsible. And when it's their money and not your money, they treat it differently. Yeah, there's one further thing you can do with your kids as well. And actually, this is maybe even a better example to your original question about seems like it should be illegal. But once your kids have earned income, once you're paying them a wage or a salary, they can put money into what's called a Roth IRA. Now, a Roth IRA is a special type of IRA where you don't get a deduction up front and you have to pay the taxes on it up front. But then any money you make from it grows tax-free forever. But the way you're doing this, you're paying your kids such that they don't owe any income taxes anyway. They can put $6,000 a year into these accounts every single year. And then when the money comes out, when they retire, or sometimes it can be used for educational expenses, it can be used for a down payment on a house. There's other exceptions for taking it out early, but it's all tax-free. So I don't know about you, but you saw those stories about, the 20-year-old who has $30,000 in the bank and look at the compound interest versus if it was 40 years old before he had that. Well, how does anybody have that sort of money? This is how. And since you're the one controlling the money, and this is what I do with my own kids. 1/3 goes into an IRA, 2/3 goes to them for what they're going to spend.
Yeah, that is a great way to do it. And that's as easy as setting up a Roth IRA for yourself. You're just doing it in your kid's name.
So yeah, you set it up in your kid's name, their social security number. And I mean, it's free. Like I do it through Fidelity, and there's not even like a monthly charge or anything. I'm sure there's charges on the funds are invested in, but like there's not any sort of monthly fee to do this. So, and again, this money is there for them, for whatever they need it for in the future. And again, even if they don't need it, if they wait till they retire, again, just that head start in life goes so far.
What investments are you more focused on at this phase of life? Are you still contributing to things like Roths or 401ks, or where's your money going?
So I do a lot of real estate investment, as I already mentioned. And partly that's because I like real estate, although it's been hard to invest this past year in real estate. There's also some great tax advantages to real estate investing, where a lot of times most of the income from real estate investing basically is tax-free. Everyone's different. For most people, the first place I recommend people put money, though, is into an HSA. An HSA is a health savings account. You get a deduction for the money when you put it in. So if you put in $5,000, you get to deduct $5,000 off your income before you calculate taxes. And then when the money comes out, it's also tax-free. Now, there's limitation on what you can spend it on. You have to spend it on medical care. Again, there's a few other exceptions for what you can spend it on. But, again, even if you're not going to have that medical care this year, you're going to have it eventually. We're all going to have it if we live long enough. But getting that, upfront tax deduction and then tax-free growth is the Cadillac when it comes to saving on taxes. After that, there's a lot of different things that can be done. I tell people, like, if you have a spouse who has a W-2 job and there's some sort of a match with a 401k, go for the match. If you're going to put in $1,000 and your boss is going to give you $1,000 extra, it's hard to beat that return on investment. After that, it kind of depends on how much money you're putting away. If it's $1,000, $2,000, $3,000 a year, an IRA, or I do typically prefer Roth IRAs if you qualify for one. Not everyone does, but if you do, that's where you can start. But if you're somebody who, and I have a client like this, husband has a day job, makes several $100,000. Wife has her company making about $80,000 a year. She basically puts every bit of that into retirement savings through a solo 401k. And again, this is another advantage that maybe you can't get working for somebody, but with your own company, there's not really many limits to how much money you can put away for the future in one of these tax advantaged accounts.
Are solopreneurs able to set up a 401k at their company, and does just for themselves really? And then could they set up even a match for themselves to do some other kind of tax advantage there?
So there is actually a specific type of 401k called a solo 401k.
Oh, okay.
That the only people who can set it up are people with no employees. Now, this means you can't hire your kids in this company, although there's still ways to do that if they're an independent contractor instead of an employee.
Okay.
That gets tricky and that can blow up in your face. But yes, absolutely, you can set up a 401k. Now, you don't get any additional bonus for a match, but everything you put in is tax deductible anyway. So it's basically the same as a match. But again, and you can put up, they change the numbers every year, but it's like $60,000 a year potentially into your 401k if you're making that much money. And I particularly like doing that today through, again, these Roth, even if you have to pay the taxes today, well, tax rates are set to go up. The Trump tax cuts are set to end in 2 years, and everybody's going to owe more in taxes. Some people are going to owe a lot more in taxes. There are people today paying 22% who are going to owe 31% on the same amount of income in 2 years. So I'd much rather pay 22% today than 31% or 35% in the future.
I'm considering asking you a political question, so I'm going to keep it light here. You can go as far as you want, but what do you see? Like you just mentioned the Trump tax cuts, like what are some of the major laws that politicians could really put in place that would be really beneficial for entrepreneurs?
That would require Congress to get its act together and function, which, given this past year and really this past decade, I'm not a big fan of. I tend to be pretty much in the as long as they don't do anything to screw me over even more, I'm happy camp. That said, like there are definitely some things they could do with the tax code and with some other things that would just help businesses out. One of the really hard things is there's a lot of tax deductions that cap out at certain amounts of money that weren't adjusted for inflation. So, maybe it made sense to put a $25,000 cap on this when you passed the law in 1980. But today, that same $100,000 or $25,000 or whatever the cap is, like, it's not doing any good. So in particular, there's one for real estate that applies. So if you're married and if you have paper losses in your real estate, which most people will have paper losses even if they're making money, you can deduct that loss from your ordinary income and avoid your taxes on that ordinary income. But that starts phasing out at $100,000 for a married couple, and it goes away at $150,000 for a married couple. And I think that was from 1994 when they passed that. Well, $150,000 then is like $400,000 today. So the number of people who can take advantage of that tax break are vanishingly small compared to it was, some appreciable percentage of the population, 4 to 5%, who actually qualified for that when they first passed it.
At what point in an entrepreneur's journey do you hands down recommend they get a CPA?
There's a lot of generalities, and then there's what's right for your company. Certainly, like until you're profitable, don't worry about it. If you're doing a side hustle while you've got your day job and you're not actually making money yet, like don't worry about that. Don't worry about hiring somebody like me. Go make more money. Some of it is know yourself. So, for example, I have a very dear friend who has kind of 5 different businesses she runs that are all small businesses, and she is terrible at doing paperwork. So for her, it made sense to hire a CPA when she was making 20 grand a year. That's probably not where it makes sense for most people. At some point, really what I would advise is when you can make more money by doing something in your company than you would, pay the CPA to do the work. So if you're going to spend 20 hours doing your taxes, and maybe that costs you $1,000, well, if you can make more than $1,000 in your company in 20 hours, hire the CPA. And that's one of the things I recommend doing sooner rather than later, because a good CPA or a good tax advisor is probably going to save you money. And I do say a good one because some of them are just very mechanical. You give them X, they give you Y. There's no thought involved. But somebody who sits there and says, "Hey, if instead next year you do this instead of this, you'll save some money." It can very quickly become a good tax advisor will save you, will literally save you money. Like they'll find more in deductions than you would have found yourself, and you're actually paying them. I mean, that's always my rule of thumb. If I can't save you more
Yeah.
money in the first year than you're hiring me, we may not be a good fit. If I
Yeah.
can't save you more money in 2 years than you're going to pay me, I will not take you on as a client because I don't want to be an expense. I want to be a moneymaker for my clients.
Yeah, you're saving them a little bit on time, but still you want to more than pay for yourself with the tax deductions. So it sounds like the best time to hire a CPA is not April 13th. It's at the beginning of the year for that upcoming tax year.
If you can find a CPA willing to take you after April 1st, you should buy a lotto ticket because you're probably more likely to win the lottery than have a good one have time to help you. Um, Actually, coming up here in December is probably the best time to hire one because there's always things you can do at the end of the year, but you have to do it by December 31st to take advantage of it. So, hiring somebody here, right around Thanksgiving, first week of December, gives you time to do that. It gives you time to, if you need to change something in your company in the new year, you can hit the ground running. If you need to create a new entity, you can start working on that. If you need to file forms with the IRS, there's some forms you can file from January 1st to March 15th, where this way you can be ready to do that when it happens. But in general, yeah, anytime through the first month of January is a good time. Honestly, probably about a third of my clients hire me during that time period. About a third of them hire me in May because they just paid their taxes. They're like, oh man, that was too much money. I got to avoid this next year. And then probably about a third of them hire me in October. And that's the same thing. They got an extension on their taxes. They just finally figured it out. They're paying it. And it's like, oh God, I don't want to owe that much next year. Let's do something about this.
Do you know if the $7,500 electric vehicle deduction is going to be active next year?
That the one that's part of the Inflation Reduction Act.
I'm not sure exactly. I just know if you buy a Tesla this year, then you're getting a $7,500 tax credit.
So there's always been a number of tax credits for electric vehicles, and they've changed. Um, there's a new so they updated this rule with the Inflation Reduction Act last year, and the problem is to qualify for the full amount, like so much of the car and the materials for the car needs to come from the domestic United States.
Hmm.
And like there's not a single manufacturer, I think, that qualified for it this year for the full amount. Because there's nothing else. You can't get the lithium from America because of the EPA regs and such. So there is a $7,500 credit available, I think, for the next 3 years, last time I checked.
Cool.
But whether or not you actually qualify for the full amount depends on the vehicle you buy.
The year before I got a Tesla was 4,500, and then the year I got it was 1,500, and then the year after, I think maybe it was 1,500 one more year, but I was like, and then it went to 7,500, so I got it like the worst time.
Yeah, the way they had set that up too was it was like 7,500 for the first 10,000 people who bought one, and then it dropped as more people bought it, but it was by make and model or manufacturer. And then, yeah, they came back with, again, it was part of the Inflation Reduction Act where they brought it back. And again, it's set to be here for a while longer. Oh, here's one. And I've got a friend who does solar consulting, and I do his taxes. But there's a great tax credit for putting up any sort of solar array. You get like something like a 35% tax credit for the price. Well, that applies to not just the solar panels and the batteries, which it didn't apply to the batteries in previous years, but it also applies to the structure. So he basically built a carport for his cars, but made it part of the stand for the electrical panels. And now this carport that he kind of needed to build anyway became part of this tax credit.
Did you suggest that to him before he had done all that?
No, honestly, he knows those tax credits better than I do because that's kind of his bread and butter. So
Nice.
He was the one who told me about that, and then I went around and told all my clients, and I've got a mailing list of both clients, people who just got on my email list, and I sent that out, and I had two people reach out and basically say, "That's great. I'm going to take advantage of this."
Especially with those kind of numbers. I mean, that's the difference of them paying thousands of dollars less in taxes. So,
Well, and exactly, and so not everyone understands this, but credits are a dollar for dollar saving. So if you have $1,000 tax credit, your taxes go down by $1,000. When it's an expense, that means your income goes down by that amount. But that only then saves your marginal tax rate. Again, for most people, 22 or 24%. So $1,000 tax credit is like 4 times better than $1,000 deduction.
do W-2 employees get $1,000 refund for the credit?
I do. I believe different credits are refundable, different ones are not. I do believe um, the $7,500 is a refundable credit, which means that, let's say you owed $6,000 in income taxes, but you got the $7,500 tax credit, you would get $1,500 from the government.
So do you maybe recommend that a lot of W-2 employees open up some kind of business, even if it's them like driving for Uber, just doing something that just all of a sudden enables all of these tax benefits? And reverse wise too, is there any advantage to an entrepreneur getting some kind of W-2 position to take extra advantage of taxes?
So there's like 100,000 pages of the tax code. 1% of it says you pay taxes. 99% says unless. Of that 99%, 99% of it is businesses only. Now, again, as you mentioned, that can be driving an Uber, it can be owning a rental property. These are businesses. They don't have to be, huge things. And there are lots of things that you can take advantage of with a legitimate business. Where I get nervous about talking about this is you'll find people on YouTube where it's like, oh, I wanted a camera, so I started a photography business, and then I wrote it off. Well, if you never actually get any jobs doing photography, if you never did any marketing for it, you didn't have a business. So I see a lot of people essentially cheating on their taxes by trying to do that. But if it's a real business with income, absolutely, because again, suddenly you can start writing off lots of your expenses that are, stuff you're spending anyway. And that's again one of the gold standards. If you're going to spend the dollar anyway, but you can make it pre-tax instead of post-tax, you come out way ahead. And it's not hard for most people to come up with, $3, $4, $5,000 in business expenses and stuff they're currently spending out of their pocket. So I absolutely encourage anybody who has the time, has the inclination, set up some sort of a side hustle. If you have more time than money, Uber, and actually I like Uber Eats. I've got another friend who he does Uber Eats, but to me he does it really smart. Just anytime he's driving someplace, he'll open up the apps and look, is there something on the way that I want to, like I'm going this direction anyway? And is it enough money to be worth going out of my way? So, 9 times out of 10, he looks, there's nothing there. He just goes about his business. But about 1 in 10 trips, it's now a business trip. And again, he makes money, but he gets to actually write off the gas, write off some mileage on the car, etc., and save money. If you've got a lot of money and not a lot of time, real estate is the best way to do it. And the second you have a single rental property, you're in business, you can start writing stuff off. And again, like there's a reason that almost every multimillionaire and billionaire you see has a lot of real estate. And it's because there is no better way to make money and avoid taxes legally than by real estate. I mean, even, the Trump tax cuts made it even better. And oh, what a surprise. He was a real estate investor, right?
Yeah.
So again, like long term, that's my goal. I expect probably 50% of my net worth to be in real estate before I even consider retiring. And I don't ever plan on retiring, but slowing down, I would say. And the only reason it's only 50% is, well, just in case I want some diversification and other things.
I keep thinking as soon as he's done answering this question, I'm going to wrap up this interview, and then you'll say something that makes me think of another question. I'm like, all right, I got to ask that one more, because at the beginning I was like, we'll keep it around half hour. And I'm thinking we're probably already over that. All right. So last question here. Is there a way that you recommend a lot of people get into real estate if they don't have more than 20K to use as a down deposit?
So first of all, like today, November of 2023, getting into real estate is potentially very dangerous. So like even if I had $50,000 to invest today, I would be very hesitant to put it in. And I would not advise a newbie to invest right now unless they're in a sub-market where it makes a lot of financial sense. But one of the best ways to do it, and this is especially good for somebody who doesn't have kids, maybe isn't even married, go out and find a duplex or a triplex or a fourplex and buy it to live in one of the units. And because it's where you're going to live, you get the owner occupied mortgage rates, which are way cheaper. You typically only need 3.5% down payment instead of a 20% down payment, at least for the first one you buy. And it's just easier to qualify. And then you can even use the projected rent from the other units to qualify for the mortgage itself. And then what you can do is after 13 months, do it again and do it again and do it again. Because as long as you live there for over a year, it qualifies under your residence and not an investment property. And then you still hold on to the old one, but you get to keep that better mortgage rate. And so that is, to me, kind of the best way to get started. And, again, you're going to need some money. But the other nice thing is when you're buying a rental property that is one you're going to be owner occupied, they don't mind if you borrow the down payment from family or friends, whereas you can't do that if it's an investment property. So, if you can scrounge up a lot and you're a little bit short, but somebody you know can give you a short-term loan on it or something, that's a great way to get started. If where you live makes sense. That's not going to work well for you in New York City or LA. But if you're in Nashville, if you're in Dallas, if you're in, Little Rock, Arkansas, that can be a great way to get started in real estate. Again, a bit of a hassle because you got to live there yourself. You got to constantly move to grow it. But it does not take too long to do that. In fact, one of my favorite podcasters, that's how he started in Anchorage, Alaska. And, within 10 years, he was a multimillionaire from just moving from one fourplex to another fourplex like 4 times.
Wow. There's so
and then
much
again, all
to
that
this.
and then all that income was basically tax-free, the way it worked out for him.
Yeah. This kind of information, I get to learning it, and it's always so exciting hearing about how much you can save, but then understanding this information so well that you know how to apply it is a whole other thing. And it's just like a whole other world because it's situational based off the time of the year, how the market's doing. Now you got to know all about real estate. Now you got to know about your specific laws, about where you live and your situation, if you're single or married. And that's why you're making me want a CPA by the end of this. Like, you inspired me to to take advantage of all these tax laws, but I'm like, I don't actually want to learn anything more because my brain is now full with the amount of information it can take on while I still have to run my business and learn all about the marketing and all of the other things that I'm doing. So I'm going to stick to podcasting here. But Matthew, where can people find you, and what is the free guide that you've got for everyone?
So my website is agorist.taxadvice.com. That's AGORIST taxadvice.com. And if you put /SME for social media entrepreneurs, that'll take you to a page. It's honestly not very pretty. Please don't hold it against me. I'm still figuring out the social media marketing stuff myself. But you put in your email and it will send you my free guide with, it's over 60. I think it's currently up to 64 different business deductions that you may or may not qualify for in your business, but many businesses qualify. And again, just like you and I were talking and I'm throwing stuff out, it's a great place to start and get ideas and just realize how much is out there.
And this is such perfect timing because this interview will be coming out this Thursday. So we'll still be in November of 2023, and they'll be able to take advantage of these things before the year ends.
Exactly. And there's always different deadlines. The big ones though are December 31st and April 15th every year, because there's a lot you can do up to that point. And after that point, you're locked in.
Well, there you have it, guys. That was an incredible interview. I got so much out of this. Thank you so much for coming on, Matthew. And you guys know where to find him. Everything he just mentioned is linked in the description. And we'll talk to you soon.
Thanks so much for having me.